Hello, and welcome to our latest Money Show Money Masters podcast segment. I'm Mike Larson, editor-in-chief at MoneyShow, and today I'm speaking with Lindsey Piegza, chief economist and managing director at Stifel Financial. Welcome to the podcast, Lindsey.
Thank you for having me.
I'm glad you could do this again, and let's start from the big picture, right? When we last spoke in mid-August, it was kind of a little bit uncertain what the policy outlook was going to be and how the economic data was going to sort out. So I guess I'm curious as to what you think the biggest developments we've seen since then have been, and whether your general take on the economy and the inflation outlook is roughly unchanged, or if that's changed at all since then.
Well, it's still very uncertain in terms of the outlook, but what we have seen is a string of stronger than expected data continuing to perpetuate the notion that the U.S. labor market is still very tight, inflation is still too high, and the Fed, therefore, still has more work to be done before we can talk about reaching that dual mandate of full employment and stable prices. So I don't know if there has been necessarily a material change in my assessment or my outlook, other than we have pushed out our call for that eventual weakness to seep into the economy. We've pushed that out about 6 to 9 months.
And, let's talk a little bit about the jobs market, because I know on LinkedIn you had posted the latest jobs market was surprisingly strong, and that you suggested that complicated the outlook for monetary policy. So let's talk about that a little bit first. I mean, obviously the headline number was great. I'm curious as what you saw in the headline and what you saw in sort of the details of that make you characterize it that way.
Well, I think the headline number, first and foremost, that surprise to the upside, certainly designates the notion that the labor market is still tight, as businesses are still hiring at a relatively robust pace. And we continue to see this imbalance between labor demand and labor supply perpetuating elevated wages. Now, we did see the growth rate of wages slow somewhat more recently, but we're still talking about an accelerating pace on an annual basis, up over 4%. So from the Fed's perspective, when they look at the health of the labor market, this suggests that well over 500 basis points of tightening has not yet led to that level of job destruction or an increase in the level of the jobless rate that typically is associated with higher interest rate policy, or is arguably needed in order to slow the economy to reach that more benign level of inflation.
And, when it comes to the wage outlook, I mean, obviously we've seen a lot of headlines about strikes, work stoppages, things like that. How does that factor into your, as an economist, how do you take that into effect? And do you think the Fed is looking at that kind of news and getting a little bit concerned as well?
Well, a one-off strike here or there, be that the United Auto Workers or the more recent strikes in Vegas, that won't be enough necessarily to move the needle in terms of aggregate hourly earnings. But this ongoing theme of higher compensation demands does speak into the notion of perpetuating expectations for not only compensation, but by extension, then inflation expectations. And this is going to make it more difficult for the Fed to achieve that inflation mandate against the backdrop of persistently sticky wage growth.
You did mention also in that commentary that the backup in longer term rates might help alleviate some of the pressure on the Fed to take further action. Can you talk about that dynamic and how that impacts things, what happens to the 10-year, 30-year, and so on?
Well, remember, the way that the Fed looks at policy firming, it's in totality in terms of not only rate hikes, but an organic change in market conditions. So if in fact we see rates sustained at this elevated level, if in fact we do see financial institutions tightening their credit standards, this may do some of the Fed's work for it out in the marketplace, maybe to the tune of 25 or 50 basis points. So that may alleviate some of the pressure on the Fed then to give us this final rate increase or another rate increase sometime next year, by again looking at the total policy firming potentially reaching that sufficiently restrictive level.
Well, let's talk about that, your Fed outlook. What is kind of your base case for, we have two more meetings, regularly scheduled meetings this year, and then obviously we'll roll into 2024. So I'm just kind of curious how you're looking at the policy outlook unfolding.
Well, the Fed was pretty clear that it's not a question of if, but how much and when will we expect that additional policy firming. The SEP, or the Summary of Economic Projections, suggests that the Fed is going to give us one additional rate hike. However, international conflict may complicate the timing of that, and what would have likely been a November rate hike may be pushed out to December. So again, a lot of uncertainty there. But when we look at the labor market, still tight. When we look at inflation, still too high. high. And when we look at credit conditions, yes, there has been some change, but not necessarily enough to say that that alone will get us to that sufficiently restrictive level. I do think the Fed still has more work to be done in terms of at least one additional rate increase. But again, that international conflict may muddy the timeline for that to arrive.
We'll talk about that in just a minute, but I wanted to ask you kind of where you stand on inflation and the progress the Fed is making towards 2%. A lot of people will cite that what's happening in rents real time, that's going to end up in the CPI on some level and so on. So I'm curious, where do you think we are in that march towards 2%? And do you think that progress is going to continue?
Well, we have seen a lot of progress in terms of this disinflationary trend. But from the Fed's point of view, it was never about getting from 9% down to 4%, but continuing on this downward trajectory back to 2%. And the last 100, 200 basis points, this is always the most difficult. So it's very important that the Fed doesn't lose its resolve, doesn't lose its focus on reinstating 2%. And in fact, Chair Powell has been very clear that orange is not the new black. 3% is not the new 2, and the Fed will not be comfortable with getting inflation nearer 2%. They want to actually achieve that 2% goal. So again, we have come a long way, but we still have quite a ways to go. And the upside risks, be that from labor costs, as we talked about, or energy prices or food prices, neither of which the Fed has control over, do pose significant upside risks to that inflation target.
I'm glad you brought up energy prices. I mean, it's always tough to talk about these things that happen that are a real human tragedy in terms of economic or market standpoint. But I'm kind of curious, you were already concerned a little bit about energy prices and the pickup we've seen recently. Do you think that the situation in the Middle East or other factors are going to work to continue to keep that elevated? And will that be an issue for the Fed moving forward?
It certainly will be an issue. And whether it's the most recent conflict or whether it's the global supply restraints in terms of production, the risk to inflation certainly is to the upside when we look particularly at the energy market. Now, I want to be very clear, the Fed would not need to perpetually raise rates in the face of higher energy costs. And in fact, that's why the Fed does strip out those volatile components of food and energy in order to look at the underlying core, which gives us a more clear directional trend of momentum in terms of inflationary pressures. And that's what monetary policy is based off, the core. But sustained heightened energy prices, pushing that reversal in the headline, will eventually seep down into core costs. And that could pose a very difficult challenge, an additional challenge to the Fed that looks to be winding down, potentially at or nearing that sufficiently restrictive level.
Now, one of the big issues, I mean, markets have kind of talked about it forever, concerns about deficits and debt and so on, but never really acted on those concerns.
Right.
It's just we pushed it to the sidelines. But, you noted recently that may be starting to change and that some of the upward pressure on interest rates is coming from markets beginning to price in more deficit risk. Would you be able to talk about that for a little bit?
Yeah, absolutely. So remember, this is nothing new. This wasn't a scenario where the debt increased yesterday. This has been a slow progression. And in fact, the government's balance sheet has increased over 95% in the last 10 years. So we're talking 1.2 times the size of the domestic economy. But the concerns over fiscal expansion have been very much in check against the backdrop of a historically low rate environment. And in fact, even as of late, with the Fed very consistent in their message for higher for longer, the market has consistently called for a preemptive end to rate hikes, and in fact was pricing in rate cuts all along the way. So this expectation of returning the cost of funds back down to historically low levels, again, kept these concerns about the fiscal balance sheet on the sideline. But now, more recently, as we do see the Treasury increasing its quarterly issuance for the first time in 2.5 years, as we did see the latest debt debate really get into the weeds and highlight the need for restrained spending against the backdrop of a message of higher for longer that investors are now beginning to absorb, well, this suggests that, yes, we're going to have to face this massively larger level of debt and finance it in a higher interest rate environment. And so investors are waking up to this eye-opening experience that we cannot continue to indefinitely spend, and that eventually debts do need to be repaid, in this case, at significantly higher levels.
I think, in worst case, I doubt it's a base case scenario for you, but that brings up the whole concept of a debt trap, doesn't it?
Absolutely. The idea that large level of debt is going to require increased servicing costs. So we're diverting diverting funds back to servicing the debt, which creates an even larger need to take on debt because we don't have that ability to spend organically. So essentially, the notion of a debt trap is debt begets more debt.
So if we do again look forward to next year, then I mean, do you think the idea, and again in your sort of forecast, the idea of the Fed reversing any of these moves should probably be pushed off into the far distant future at this point?
Well, at the very least, I think the Fed is going to reverse course at a markedly later and slower pace than the market is currently anticipating. If we look at the latest September SEP, again, that summary of economic projections, the Fed already significantly rolled back expectations of reducing the rate over the next 15 to 18 months. Initially in June, the Fed said they would likely give back 100 basis points in 2024, but as of September, they cut that in half to just 50. And should inflation, again, fail to perform as expected, meaning less improvement, I would expect the committee to roll back again their expected rate cuts in the coming 12 to 18 months.
One last thing related to that before we get to wrapping things up is the yield curve, right? I mean, you noted that the 2s, 10s, for example, have dramatically uninverted, or should say have down to 26 basis points, I think, recently, which after being over 100 or something like that at the most inverted levels. What do you think the messages there are coming from the bond market?
Well, I think the bond market is suggesting that this less inversion, or I should say with the less inversion, the bond market is insinuating that we're in a new normal environment, that the longer end of the curve, in order to compensate for that increased duration risk, needs to climb significantly higher relative to potentially this new normal level of rates on the short end, as the Fed consistently keeps rates higher for longer.
And one last question. I know you're going to be joining us for the Money Show Traders Expo in Orlando. Can't wait to see you again in person. Any sneak peek you'd like to offer at what you think you're going to be talking about?
Well, I think we're going to have a lot to talk about in terms of the Fed's pathway to higher interest rates as we look out to the end of the year, and what we can expect for that pathway out to 2024, as I do expect, again, inflation to significantly underperform relative to expectations, not just the Fed's forecast, but more importantly, the market's expectations for inflation as well.
Well, Lindsey, thank you so much for your insights. Thank you, everyone, for watching. If you do want to hear more from Lindsey and dozens of other top investing and economic experts, I do encourage you to check out the Money Show Traders Expo Orlando. It's scheduled for October 29th to 31st, and you can find more details in the link below. Finally, if you enjoyed this video, learned something new, be sure to hit that like and subscribe button, and you'll get all of our content updates. Lindsey, thanks again for your time.
Thank you for having me.